Welcome to our quarterly financial planning webinar. We do two webinars each quarter, one on a financial planning topic about midway through the quarter, and the other on economic and market update that we hold early in the quarter. Today, our topic is inflation strategies and cash flow planning. It is November 16th, and we are recording today's program. I'm Chris Boyd. Thanks for being here. I'll be sort of your host. I feel like Fantasy Island. I'm your host. In any case, thanks for being with us. And I wanted to make sure to remember to mention to you that as we are recording the presentation, if you do ask any questions, your participation implies consent to be recorded. Additionally, as a compliance matter, we do have notes at the end of the presentation, but I want to remind you that opinions are subject to change and information has been derived from sources thought to be reliable. Let me introduce you to our panel today. We're going to be joined throughout the presentation by members of our team, Mike Perna, Jeff Tamanang, and Kathy Ingersoll. Mike and Jeff are both advisory representatives with our firm. Kathy is our marketing director. But a lot of great insights to share today, even as our presenter. She's going to be sharing some ideas on when we get into talking about inflation. So, Kathy, a little unusual for you, right, to be in the presenter role.
I'm usually behind the scenes, but glad to participate today.
Glad to have you here. In that role. We're also joined by Ryan Tufts. Ryan, thank you for being here. Ryan is with Harbor One Mortgage, and he is a loan officer. We're going to be talking a little bit about what's happening in housing and interest rates as it relates to that. So thanks for being with us, Ryan. We'll bring you into the conversation in just a few minutes. Give everyone an opportunity to get a sense of what we're planning to talk about today. And the agenda is, we're going to talk a little bit about inflation. We're going to talk to Ryan about housing. We'll go through some ideas in a little bit of a panel format to talk a little bit about different ways you might be able to save a little bit of money in a time when costs are getting tighter. And there'll be opportunity for questions along the way. Though, if you have questions, there's a Q&A button that you can use on your screen. There's also a chat feature, and if you prefer to ask a question verbally, you can raise your hand. The webinar will be posted on our website and YouTube channel later today. So in fast-changing times, we encourage you to listen to our radio and podcast radio program. It can keep you up to date on what our views are as things change over time. Let's jump right into it and start off with inflation. We usually think of this as the consumer price index, as the index that most consumers are familiar with. The Federal Reserve pays attention to a slightly different indicator, the personal consumption expenditure index. In either case, though, we're seeing some signs that inflation has been very high, but maybe starting to show signs of tapering modestly. The last 12 months, all items increased to about 7.5% in October, which is down from its prior high. And that's encouraging that we're seeing some reductions. In addition, the core index, which excludes food and energy, is a little bit lower, and those are that's the part of the economy that the Fed Reserve tends to pay attention to when it comes to its decisions about how to deal with interest rate hikes. In any case, but if you do include food and energy, which we all do in our budgets, you can see it's certainly been a high point as well. When it comes to inflation, I think we kind of have to step back a little bit and think about how do we make sense of what's going on and what's causing recent dramatic changes in pricing. And, I think to do that, we need to look at the pandemic. We're still dealing with aspects of the pandemic. There was an enormous amount of government stimulus in various forms of assistance when we shut down the economy. In addition to that, the Federal Reserve reduced interest rates to near 0%, and that was stimulative. Supply chain disruptions have been a factor, and some change in government policies, and of course, even the war in Russia against Ukraine. All of these have had, to some extent, a contributing impact on the stimulating the high inflationary environment. The Federal Reserve has been the one we focus on when we think about what's changed in trying to offset these risks. But we also recognize that fiscal policy is different today. There's a lot less spending. That's not to say that there's not overspending, but there's a lot less spending coming out of government in Washington. But the Federal Reserve in particular, you can see on this chart, has been very aggressive in raising interest rates. And the rate of increase is something we haven't seen in a very long time. It's a dramatic level of increase. So we're up near 4% on the Fed funds rate at this point. And in less than a year that this has all happened. And so that does have some impact certainly on your portfolio as well when it comes to the bond part of the investments. I will talk a little bit about the effects of this and its consequences on the economy. Suffice it to say that higher interest rates make it more costly to access credit and thus slows the economy. That's what the Federal Reserve is trying to accomplish. It also gives investors more potential income from some of their investments, and it causes stock investors to reassess what's the multiple they're willing to pay on how much they're willing to pay for stocks. So there are some good and bad things when it comes to inflation. Employment is at pre-pandemic levels. We have a very tight labor market, but people are quitting jobs at a high rate and able to replace them quickly. All this tends to make for a little bit more inflationary environment. So that said, even inflation has some pros and cons. And by the way, this is one of them. Looking at Social Security, hey, we've seen some jump in Social Security benefits for retirees to help offset some of these higher costs. When it comes to wages, wages are also have increased dramatically. It depends on which industry you're in as to the actual rate. But of course, on the other side of that, we all know that the costs of things have gone up considerably. And the real wages, when you factor in what those costs have gone up, haven't really quite kept up with the rate of inflation. So on the other hand, again, another one of the positives we might look at, kind of an unusual thing, Medicare premiums have been set to decrease. I haven't seen that in quite a while. So, on the whole, it's not something we're eager to have happen, to have high inflation, but one of the most dramatic illustrations of the drastic impact of inflation has been on housing. And to speak to that, I will turn things over to Ryan Tufts from Harbor One Mortgage. Ryan, thanks.
Thanks a lot, Chris. Thanks for inviting me. As Chris said, my name is Ryan Tufts. I'm a mortgage lender with Harbor One Mortgage. For compliance purposes, my NMLS ID is 1639731. I'm a regular guy. I'm married. I have 2 daughters. I like basketball, love reading, and I really love dancing with my girls who just love they're at a very silly age. But on to housing. So as you're thinking about your family and making decisions for the next year or two, whether you're going to downsize, help your family buy a new house, if you're going to relocate to Florida perhaps and just live life in a much warmer climate, or if you are going to buy that kind of dream property, whether it's a beach house or lake house, or just make that big purchase that you've been saving up for all these years now that you're in that position to do that, or if you're going to look to buy a property and maybe either live in an accessory unit or help your kids save up money to buy their house while they live in the accessory unit above the garage. So just as you're kind of having these conversations with your family, I get asked a lot, is now a good time to buy a house or invest in real estate? People over the past year, I think they've been, some of the intensity and the busyness of the market has made them feel like the 2006, 2007 housing market. But I want to point out some big contrast between what happened then and what's happening now. And it's a tried and true concept, housing supply and demand. So I first want to help us understand what the demand side of housing looks like. And it's based on household formations. So that just means that a couple or an individual is moving out of their parents' house. They're having that electric bill turned on for the first time. Whether they're renting their first apartment or buying their first home, a new household is being formed. And we can see right now, we're forming about 1.4 million houses annually in America. Typically, the most likely age to do that is in your late 20s or early 30s. 33 is kind of the mode year when most people make that jump. And households are being created and destroyed all the time. If a couple is together renting an apartment and they break up and they each get an apartment, that's a new household. It's another electric bill being turned on. It's another unit that's needed of housing. So we can see historically this has come up. We are in kind of a bumper crop of people aging into forming their own household, of people in their late 20s and early 30s. A lot of people were born in the 80s and 90s, more than there was in the 70s. So we have millions every year of people entering the market. So how are we going to house the 1.4 million households being formed every year? Well, we're trying. There's housing starts, which means permits that have been issued to build. There's 1.7 million of those nationwide, but we also have to account for the 100,000 houses, give or take, each year that they're just kind of falling into disrepair or being torn down. So that leaves us about 1.6 million of new homes. Actually, if you could go back to one, we can a little bit more discuss on this slide, but so it looks like we have a surplus. If we have 1.4 million new people that are going out on their own and getting that first apartment or house, and we're building 1.6 houses, that sounds like enough, but it isn't. And here's why. Not all those houses that were permanent actually get built. And even some of those are for second homes or seasonal properties, which someone buying their first house or just kind of entering the market isn't going to move into. So if we follow the math on the bottom of the slide here, if the same 100,000 houses are being destroyed, yet we need 1.4 million new houses a year nationally, where I have an annual shortage of 200,000 houses, which is a lot. So you're seeing families double up, or in some cases triple up, or they're staying home longer than normal. It's not because they don't want to move away, it's just because there's not enough places for everyone to go. So Chris, if you could go to the next slide, please. So, and how is that happening? You may be hearing in the news that inventory is up, and that's true, but it's up from a very, very low level. If you look back even 4 or 5 years, there was almost 2 million houses for sale, and now we're at about half that level. So that's a giant increase. And if you'll notice on this chart, the unusual shape of it, that's the seasonality of the housing market. It's called the spring market for a reason. It's not just because it's a bright, sunny time of year, but because most families looking to move, they want to get to their new town before school starts. I mean, you remember from school, people kind of make their friends in the beginning of the year, cliques form, you're getting used to the teacher. It's disruptive, most parents would say, to move during the middle of the school year. So people try to avoid that. And we can see that referenced in this chart. So each spring we'll kind of see more housings come online. So typically if somebody's selling their home in the winter time, it actually could be an opportune time to buy if you don't have kids, because they probably really need to sell, because it's typically not the most common time to do that. Looking at the next slide, there's actually more to the inventory story as well. So there may be 1 million homes for sale right now, but a huge chunk of them, 600,000, are already under contract. So if you've been on Zillow or Realtor.com over the last year, you might see a lot of listings. You have to kind of go through your filtering and, hey, show me only the ones that are actually still available versus the ones that were available yesterday but went under contract over the weekend. I want to know what I can actually bid on. And that's a much lesser percentage of the total houses available. So if we compare this to over the last 5 years, we're at a really low point of houses you can actually bid on. So that's why this past spring and summer, we saw some very, it was the extremely market tied to the sellers. Actually, Chris, if you could stay back on that one for a moment, that's okay. No, your transitions have been great. So the market was very frothy. People were making very aggressive bids, 10% over the asking price. In some cases, $100,000 or more. They weren't getting home inspections. They were waiving anything to really accommodate the sellers as much as possible to win. In some cases, that wasn't enough. We've started to see that taper off a little bit as interest rates have come up, and they've just have made the monthly payment on any house a little bit more. So that has kind of dampened the seller's market a little bit, yet it remains a seller's market because of how few homes are available. So you might hear in the news, hey, available homes are up 50% or inventory's up 50%. Great. Yeah, but that's from like an all-time low. So it still remains a challenge to find inventory available for what you're looking to buy nationwide and especially in New England. All right.
Do you think that's in part a consequence of the pandemic, and will that alter with time, or is that something that's more the demographic issue?
Both play a role. We saw 2020 and 2021, I think, were big years of relocation, and it's some of what we're still seeing. People with increased job mobility, now that you can remote into work, people are really starting to making moves more than they had been the previous few years, for sure. And New England's a nice place to be, as is, Florida. People are, going to where they want to be because they're not tied to their desk anymore.
Yeah.
So another thing that gives me confidence that the housing market remains strong is that even if you're not going to buy a home, it's very difficult to find a place to rent. The vacancy rates nationwide, Massachusetts and New Hampshire especially, are super low right now. It's very difficult to find a place to live, and landlords can charge a premium. All right, go ahead, Chris. So the demand of housing remains strong. Supply is still not enough, and they're not able to build enough houses because we lost really a generation of builders in the Great Recession from 15 years ago. So there's just not enough to do that. Other impediments we'd have to get into another time, but there's not enough housing. The second question I get asked most often is what's happening with interest rates? So as Chris was just talking about with his dialogue on inflation is the biggest driver of interest rates. I mean, a pizza is not $10 anymore. Pizza is now $20. So if you could have prepaid for your pizzas 10 years ago at $10 and got unlimited pizza today, well, you would have done that, because now if you get a one topping pizza, it's $18 to $22. The cost of our money decreases over time. Lenders know that. So if they're going to lend out $500,000 today, they want to recoup that same buying power over time with a little bit of profit. That's the business that they're in. But one thing I want to point out here, and Chris hit on it perfectly, the inflation tide, though inflation's still high, it may be turning. The recent set of data showed that inflation was starting to ameliorate. So that's a good sign for inflation. And then the second piece is a little more nuanced, but I wanted to kind of clue you in on it. Typically, mortgage rates track something called a 10-year treasury note. That's government debt that the government borrows on for 10 years at a time to help us fund our annual budget deficit that we always have. So mortgage rates are typically 1.75% to 2% over that 10-year treasury rate, which you could observe by just searching TNX and whatever your financial news website is that you like. So you can watch over the last 30 years that this has held pretty steady. But right now we're in a position where that's a 3% difference. So I think that's kind of overdone, and we're likely to see that come back down. So as you continue to follow Chris's news and updates in the podcast, as you hear about inflation going down, mortgage rates are likely to follow it. So if, for example, right now this 10-year treasury is around 4%, just under, if that were to get back down to 3%, you would very likely see mortgage rates follow to about 5%. Now, there's a lot that's going to happen for that to come true, but the two tend to move in tandem, and I think we're due for an overcorrection on that. So I think that is good news for interest rates in 2023. So if you were to buy something soon, I think you were very likely to have a refinance opportunity to secure a lower rate in the next, 12 months. So as your family's making these decisions, how do you get the money you need? If you are moving properties and you own your property outright, great. But if you want to secure a mortgage, there's a few ways to do it. We'll touch on a couple of them just to refamiliarize ourselves with some of these terms. Conventional loan is kind of the most standard way to do that. You can do it with 5 to 20% or more down. Standard terms, it's kind of what realtors that are selling properties love to see. It's very easy for them to do. Adjustable rate mortgages are kind of coming back in popularity. Kind of a more understandable term for those is 5-year fixed rate, 7-year fixed rate, or 10-year fixed rate loans. So you're getting a fixed rate for a short amount of time that is lower than the 30-year fixed rate. And then after that initial term of say 5, 7, or 10 years, the rate has the ability to go up over time. There's pros and cons to that. It's not a right situation for everybody, but typically somebody either moves or refinances within that 5 to 10 year mark anyway. So it's unlikely that somebody would end up paying a higher rate. But again, you'd want to have that detailed conversation with your financial advisor, with your mortgage professional, if that time comes. We're running short in time, so I want to just quickly explain the few other items. Jumbo loan is when you're buying that dream property and you need to borrow more than $647,000. Strangely enough, right now, the rates on those are actually, in some cases, lower than if you're borrowing less money. So there's a weird scenario where you could actually borrow more money and have a lower payment than if you bought a smaller property. Not in all cases, but it could happen just because of how the interest rates are that much lower. Second home financing, the government made a change at the beginning of the year to kind of help, in a way, help first-time home buyers. They're charging a surcharge on second homes of a 3% fee. So on a $500,000 house, that's $15,000 extra. Some lenders, including us, have found a creative way around that by lending their own money versus the traditional way of selling mortgages on the secondary market and having kind of an unlimited pool of funds to help you avoid that fee. So basically it saves you 3%. And then lastly, if in your conversations with Chris, you're talking about diversifying and perhaps looking at investment property, you can do that in a fairly straightforward way, typically with 15% down on a single family property or 25% down on multifamily. But that's always a good place to start that conversation, would be with your trusted financial advisor. So we hit on a lot. I'm not accustomed to doing a monologue like that. But Chris, thank you for
Great job.
Kathy and
Yeah.
panel. Thanks for inviting me on. I'm a
That was
housing
great
nerd.
content, Ryan, and I'm sure, we may come back to some of those kind of questions to follow up with you at some point. Those are really interesting data points that you shared and helpful insight. You mentioned the likelihood that, the thought process, maybe interest rates will come down in time, and the adjustable rate might be part of household and deal with that, maybe refinance at some point in time. One of the things we've been hearing about more frequently lately is people are using points again, and we haven't seen that in a while. What's your take on the advisability of paying points?
Sure. So historically, points has all been a math calculation. So a point is a fee that you pay as part of your closing costs. It's equal to 1% of the amount of money you're borrowing. So on a $500,000 loan, 1 point costs $500,000. So typically, if you paid 1 point, your interest rate might go down by 0.125 or 0.25. So the savings was, you probably had a 4 or 5 year break even to get your money back. Typically wasn't something I would suggest. However, right now, because of just kind of how weird of a bond market we're in, and mortgages are based on bonds, we're seeing a lot of value. So if you're paying 1 point, you might be able to save 0.5% on your interest rate, which is a big deal. And it could really chop your payment, tens or in some cases hundreds of dollars a month. So it's worth having the conversation, doing the math, and figuring out, how long am I going to be in this property? What do I think interest rates are going to do?
So it all comes down to how long you're going to be there, probably, huh? Or avoid refinancing, be there and not refinance.
Right.
All right. Ryan, thank you. Your wealth of information. We have your information up. If anybody needs help, you can certainly reach out to Ryan for that. Thanks for making the time with us, Ryan.
Very welcome.
We're going to continue the conversation. And to do that, we're going to involve some of our other team members here in a little bit of a panel discussion to get us started, Jeff Tamaning has given us a little video. Let's start with this.
Well, here I am at the gas station. Looks like I'm going to be paying, let's see. There it is, $3.75 a gallon. But I probably could have saved more maybe if I've gone somewhere else. But unfortunately, I just waited until I needed gas. So I'm kind of stuck with where I am right now.
Excellent. Well, as it relates to that, Jeff, just wanted to share with you, I happened to be on a AAA app the other day. I'm a AAA member. And one of the things right on the AAA app is where's the cheapest gas near you? So if you have your AAA app next time, you can maybe find that better price if that wasn't the best price.
That's true. I don't use the AAA app. Fortunately, I mean, I do if for some reason I need a tow. But if you have your smartphone on, you can even Google and just put in cheap gas near me and you see what comes up.
Oh, good.
Yeah.
Well, what are some other types of techniques that consumers can entertain in thinking about how to deal with the rising costs of energy when it comes to, or their commute, whatever it might be?
I think in general, there are some tips you can take into consideration. One is just paying with cash instead of a card. A lot of
yeah, you can get a
gas
discount
stations,
doing it that way.
Yeah, you'll get a discount because the retailer doesn't have to pay transaction fees to the credit card company or their merchant who's doing that. So that's one thing to look for. Just make sure you see as you're driving by, there might be a different cost, a different price for cash versus card. There are gas rewards cards that don't cost anything to have, whether it's
sort of a loyalty reward kind of thing.
There's a loyalty rewards. There's also credit cards that that are issued where the bank and the gas company, like whether it's Shell or Mobil or something like that, will give you rewards as well if you use their card. They're cheap.
Yeah. Well, I was just going to say one of the other things that you had talked about in your own experience was perhaps the kind of car you drive.
Yeah. So, Chris, it's interesting you bring that up. I happen to have purchased a hybrid 3 years ago by accident, and I wasn't really looking for a hybrid. I knew I wanted to buy a car that was 2 or 3 years older and save some money there, but still get some of the same features and hopefully with low mileage on it. And at the time, gas prices weren't as high as they are now. And I found that the car that I bought, which was a Honda Accord, a 2017 Honda Accord, which I purchased in 2019, there was no price differential between the hybrid and the traditional gas-powered vehicle.
Oh, you lucked out there.
I did, and I know you and I have talked about this, and when gas prices were down, when you bought a new hybrid versus a new gas vehicle, it could have been thousands of dollars difference.
Well, to your point, Jeff, I mean, I had this very same experience where I was looking at a car a couple of years ago, and it was a couple $1,000s more for the hybrid. And I started doing the math of, my mistake was I assumed the then rate of gas would be constant. And of course, that wasn't the case, So I looked at it and said, well, it's going to take me so many years to break even.
Yeah, it was like 5 years or whatever.
Yeah, it wasn't so compelling. I was like, I don't know. So as much as I thought it would be nice to have the hybrid, but should have thought of the fact that gas prices change time.
Well, I wasn't thinking that way. It just happened that the cost for this vehicle was the same to purchase it. So
Yeah,
I went, just
Well-
because it wasn't a traditional color. It wasn't the black, blue, silver.
and that got
My
you a
car
good
has
deal in
kind
the
of
process.
Yeah, and so I was like, all right. Fortunately, I'm not driving a banana colored car or a bright green,
Yeah,
but it was enough that, okay, this looks
it
fine.
worked.
I'm gonna buy it. And
Mike,
it's nice.
one of the things we were talking about in preparation for today was like, when's the best time to buy a car? And you had a pretty humorous response to that. Do you remember what you said?
I do not remember what I said. Maybe
I think
you could
this was
refresh
Mike
my
who
memory.
said this. Do you remember, Mike?
Yeah. When you need one. I mean,
Yeah, it's like okay, the car broke down. I need one. But generally speaking, who could tell us when's really a good time to be buying a car? When there's some tips that people might think about.
Yeah, there are a few. I've read that Mondays are usually a good day to buy a new car because other potential shoppers are working, and so the reps at the car
As opposed to the
dealerships-
weekend or something.
Yeah, the reps at the car dealership are just focused on anyone who comes in the door. End of the year, month, and model year. So as far as times of year, October, November, December are usually safe bets. Dealerships have sales quotas, and you break those down into yearly, quarterly, monthly sales goals, and that makes it a good
It
time
makes
to
them
go and get a
good
good
timing
deal.
toward end of
And then
month,
finally,
perhaps. Yeah.
holidays, you can get some deep discounts as well. So, here.
One of the things that comes up in financial planning, financial planners often will say, don't buy a new car, buy a car that's previously owned because there's so much depreciation that happens, once you drive it off the lot. Not everybody likes to do that, but oftentimes we do get the question as well, should I buy or should I lease? Do either of you guys have any insights as it relates to that question for consumers?
Chris, I'm a big person for buying. I've had some difficulty with the leasing. You have a set number of miles, and if you go over that number of miles, it really adds quickly to the cost. I like
Driving habits can be a big part of that too.
driving
you know,
habits.
How much you drive. Yeah.
Yeah, I mean, the other thing is that when a lease comes due, you've got nothing. I mean,
Yeah, you got to throw more money down and start all over.
yeah. So I'm not big on leasing. I personally, I never buy a car that's new. I always buy a car that's maybe 3 years old and has between 30 and 40,000 miles. I mean, for the way cars run today, you can get 200,000. So if you're buying a car between 30 and 40, I mean, you will probably have at least 10 years, if not more, remaining on that car.
It's a good point, Mike. I think, from a value perspective, the math of it, that's a good answer. I think oftentimes we do have clients who have a habit of transitioning from one car to the next, every few years. And if that's the case, a lease can be a good way to, keep those costs efficient, as opposed to buying and selling and so forth. But on the whole, there's a variety of things to consider: how many miles you run, how often you buy. If you're willing to buy a car and hold it a long time, buying it secondhand, holding it a long time, like you just described, Mike, really is a better practice for getting the most bang for your buck, so to speak.
I mean, there are some, I agree wholeheartedly with both of you. I bought new cars in the past. I bought used cars. When you're purchasing and holding for the long term, you're in a better position financially normally with the used car. But there are some advantages of leasing. You are driving the lease during its most trouble-free years, as far as it being new. Maybe you get more
Retirees
warranty.
oftentimes value that notion that they get the latest
Very
safety
much so.
features, the latest quality that they don't have to worry about breaking down, right?
Free oil changes can come with that, like scheduled maintenance.
You're paying for them. They're not free.
You are, but it's still, I mean, if you're really looking that, you take a look at what's offered. If you, let's say you have a business, you're a business owner or, whatever part-time business, there could be some significant tax advantages too for the business. So
It's a good point.
yeah.
One of the things that comes up in addition to that question of lease versus purchase is when it comes to a purchase, the financing of that, when should I use cash? When should I borrow? Should I do it through the lender? Should I do it through a bank? What thoughts and suggestions do you have as it relates to that, Jeff?
Well, the paying in cash is usually the simplest, and that can get you a lower price much of the time. Obviously you can get car loans from your own bank, another lending institution, or at the dealership through their financing. I think before, if you can do some planning ahead of time, it's helpful because, you can, maybe you check your credit score, you figure out, you see what other party financing options are out there.
Mm-hmm.
One thing that the three of us talked about before this webinar was, you could go to the dealer, buy the car, whether it's used or new, take their financing, and then refinance it right away by shopping your local banks.
So maybe getting a good deal by doing the financing with the car dealer, but maybe then turn around and get a better rate or something elsewhere.
Correct.
Kathy, you've got real life experience in this topic as well, I'm sure. Did you have anything to add? I didn't mean to exclude you from this discussion.
No, that's fine, Chris. That's fine. I'm a big believer of, I've always bought executive lease cars that have, maybe 10 to 20,000 miles on it, and gotten good deals on those, and, ended up with a nice quality car that way.
Nice.
Chris, I just wanted to add a couple of things.
Please.
If we're looking just in terms of finances, number one, some cars hold their value better than other cars. For example, 8 years ago, I bought a Toyota Tacoma, a small truck, and I bought this through Car Gurus, which I'll talk about. But the value of that truck hasn't depreciated since the day I bought it. I paid $16,000 for it, and if I was to sell it today, I could get $16,000. Very unusual case, but there are some vehicles that simply hold their value very well. The other thing is, I did go on a site called Car Gurus, put in what I was looking for, and the way the site works is you put in how many miles you're willing to go out. So it starts with 25, then 50, then 100, etc. So from where you live, you want it close, 25 miles. You don't find it, go out 50 miles. You don't find it, go out 100. I actually found the truck I bought somewhere in the middle of Vermont. Okay.
That's funny. Yeah.
We bought it. So it worked out really well for me.
Excellent. Mike, one of the things that we also wanted to talk about was the cost of energy and winter approaching. There's probably some tips that people might have for how to be prepared for that. Do you have any thoughts to share with our audience?
Yeah, I mean, my wife and I bought our house almost 40 years ago. And the house was built in the 1950s, and it's been a very nice house. But houses that were built in the 1950s have all kinds of, issues in terms of heat retention. The windows weren't efficient, the doors weren't efficient, there was no insulation. So we brought in somebody from Mass Save, and they did a complete audit on the house. And, we couldn't do everything they recommended, overnight, but over time we did. And now we have a house that's, very energy efficient. And, the cost for the mass audit was nothing. It was zero. They do it for free. Okay. And every year, we save how much I don't know because I wouldn't know how to compute it. But I mean, the house is so much warmer. We don't have to go to the thermostat and turn it up to 85 because we're losing, 10 degrees because of poor windows or doors or openings that we're not even aware of. So, work on getting your house in the best, shape you can in terms of energy preservation, and that'll go a long ways to helping you.
Kathy, did you have anything to add to that? I know you seem like you had some insights on this topic earlier.
Yeah. I think the most important thing is these are just common sense things, right? But when you do them and practice them, you can see a cost savings. One is, leave your curtains open during the day, get the sunlight, and then close them at nighttime so you keep the heat in. Maybe keep the thermostat. I don't remember the number right now, but for every degree you turn the thermostat down, you save X amount
So
of
much
money.
off. Yeah.
And so maybe wear a sweater or put some socks on during the winter. Use a space heater. I mean, they're all probably common sense things, but I can't say that I practice what I preach all the time. So
True enough.
I'm going to try to do better.
Fair enough.
If you have a partner, cuddle.
Yeah.
Yes.
One of the things that I'm sure you've been asked before, Mike, is should I get solar? And I think that's a common concern. People are thinking about maybe getting solar panels, trying to cut costs over time, but maybe be more environmentally aware. But there's some costs in doing that. My experience has been you got to really do the math in each instance to evaluate and see what kind of tax benefits they're getting. Do you have any observations to share on that?
Yeah, I mean, it's unfortunate that the solar panel industry is still quite expensive. And, the catch-up time is something like 30 plus years. So that doesn't take into account inflation, but that's, pretty much a disincentive, to the solar paneling. The people I see who do use it are the ones that are extremely, environmentally conscious. They're doing it more for the environment, I would say, than they are, to try to save money in the long term.
So I have seen people who have, like, because of their positioning, they have all kinds of energy surplus that they can share with family and so forth. So there can be some perks to that. Let's keep moving because we want to also talk about groceries. Let's start with a little video that Kathy has prepared on that topic.
Food prices have risen 11.4% from August of 2021 to August of 2022, according to the most recent Consumer Price Index. Nearly every food item is now more expensive. Bread, for example, is up 16.2% over a year ago, and the price of eggs has increased almost 40%. Dining out is more expensive too, with the cost of dining out being about 7 to 8% more expensive than it was a year ago. Next, we're going to share with you some ways that you can cut your grocery bill and save on dining out.
All right, Kathy, I like these videos you guys did. Nice job. That's kind of fun. So, but you had some additional comments to share as it relates to dining out and groceries.
Yes. I felt like a Channel 5 investigative reporter there in the grocery store.
There you go. Yeah. Nice.
And again, I'm going to say things that are obvious to all of us, but they're all good reminders on things we can do to kind of keep our food budgets down. When you're at the grocery store, clip coupons. There's still grocery, the flyers in the newspaper. And if you are if you've signed up with a loyalty program, and have an app on your phone from your grocery store. Oftentimes the coupons are digital, so you just go through and click the ones you want, and when you check out at the grocery store, they automatically apply. The other benefit of having a loyalty program with your grocery store that you frequent is that, you know, sometimes when you purchase up to like $100 or whatever, sometimes they'll give you a free item that they are promoting that week too. So not
Seems
a
like you
bad
can't get
thing.
out of there without spending $100 these days,
Yeah,
right?
exactly, exactly. But I'm amazed sometimes when I do those digital apps that the savings they really do add up. Sometimes up to $20 on $100 bill.
Hmm.
You know, the other thing you can do is join a wholesale club. If you have the space and you use large quantities of things, you can buy in bulk, and that will save you on the per item unit or per unit
The
item.
per unit cost, yeah.
Exactly, exactly. This is something I have a hard time with, but plan ahead, figure out what your meals are going to be for the week, make your grocery list, buy what's on your grocery list. Don't do that impulse buy because, you know, the box of
Great
Oreos
point.
looks good. Just stick what's on your list. And if you do
Be
that,
intentional. That's a really good point.
absolutely. If you do that intentional planning, you can also take into consideration what's being offered on sale that week.
Yeah, that's a good point. You know, I think when we do that, Kristen does that from time to time at home, and you know, plans for the week, what we're gonna have for meals. We eat more efficiently in terms of like, we're not wasting food. We're also less likely to go spend, you know, takeout or something unnecessarily. So yeah, and then you can plan maybe what's on sale. That's a good point.
Right, or even generic brands. Sometimes you'll pay less if you buy the store brand as opposed to the national brand.
All right. Anything else?
Dining out, yeah, I've got all kinds of great ideas for dining out, how you can
Okay,
save
yeah.
money. The first one is just don't go dine out, right? Eat at home. No.
It saves money if you're trying to
um,
cut costs, right? Yeah.
I know what we do is my husband and I will buy one meal and split it as opposed to buying two separate meals. That helps our waistline as in addition to our budget. You can, and this is a really neat idea. There is a website where you can go in and you can buy discounted gift cards. So if somebody gave you a gift card for $100 at some local restaurant chain, I'm going to sell it to this website, and someone else can go buy it now, maybe for like $80. So they're getting $100 worth of a gift card for $80. So that I thought was a pretty clever way, as opposed to having, piles of gift cards sitting in your desk drawer and never using
Collecting
them.
dust,
Two
yeah.
people can benefit that way. Of course, you can get the birthday discount. You only have one birthday a year, though. Lunch is oftentimes less expensive, lunch or breakfast, less expensive than dinner may be. I know sometimes when we splurge, when we go out with certain friends, you find out that you're spending more on drinks than you are on actually food. So, drink at home. If you're going to drink at home. And then another thing I thought was kind of interesting that I saw, if you're a Starbucks lover, you go out for your coffee, you realize that morning coffee every day can add up over time. The cost of it. And there are, if you go look on YouTube or on social media, there's all kinds of apps. Instead of getting like the mocha grande latte, you can buy 3 cappuccinos and put a cup of cold milk in them and save about half the cost of that. Or get your ice on the side. Don't have them put ice in your iced tea, get it on the side so you get more tea and less water. So those are just a few things that I came across as ways to save money on food.
All right, guys, anything to add to that?
Let me quickly say this. Many restaurants, even fast food restaurants, offer senior discounts. Okay.
Ooh, good one, Mike.
Okay, there are certain days of the week that, seniors can, eat for, I don't know, maybe 50, 60% of what the original cost would have been. Okay, whenever you go to one of these fast food places, they'll never say to you, "Are you a senior?" Okay, because if you are, you get this. Just you have to ask for it.
Yeah, good point. Affinity groups, I mentioned AAA earlier, can also be a useful tool.
Yeah, you
sometimes.
have to ask for it. As far as going out to eat, my wife and I, we enjoy going out. But, we'll usually go to a restaurant that offers, a sizable portion, but we'll only eat half. Okay, we'll eat half in the restaurant and take the other half home and have it for dinner, the next night. Okay, so essentially, we're getting two meals.
A twofer.
Yeah.
Yeah, nice. Kathy, I understand that a lot of credit card debt has been accumulating, which is something we haven't, in the aftermath of the 2008, it seemed like people had really cut back on their debt. Tell us a little bit about that.
Yes, well, the credit card debt in the United States is 887 billion. This is according to the Federal Reserve report. There has been a 13% increase in credit card debt year over year, and that's the largest year over year jump in the past 20 years. There are 54% of all active cards have carried a balance, are carrying a balance on them in the first quarter of this year. And
Wow.
of course, with interest rates going up, there's concern because that means credit card rates are going to be going up as well, and people are going to be paying more for their purchases. The good news is the delinquency rate on credit card payments is low. It's 1.8%. However, this is a third straight quarter that it's been going up. And during the Great Recession of 2008, delinquencies peaked at 7%. So right now, as I said, they're at 1.8%. And really,
Well,
the best thing you can do to avoid that paying that interest, because that interest isn't getting you anything. It's just, your money's evaporating, is just one, don't incur the debt. Pay your credit card off in full if you can. And if you can't, then at least pay off the balance in full and maybe a little more if you can each month.
Yeah, and as you said, the rates that credit cards charge are tend to be very high, particularly if you have a late payment. You can get really whacked. So that may be an important consideration for selection. I think it's a mistake to kind of jump from zero interest to zero interest. You can end up with too many cards and too much debt and problematic. But for those people who are dealing with that, maybe we want to suggest checking in, and maybe we can help think about that. Mike, you had an observation, I think,
Yeah,
when we were talking about this as well.
Right. A couple of things, Chris. I would say this. Listen, there are any number of people out there who are drowning in credit card debt. Okay, stop. Okay, why don't you try to make an appointment with AMR so we can help you figure out a way to get credit card debt off your back? And in addition, there are credit card counselors, and these counselors can negotiate a lower rate for you, or let's say you owe 16,000, they may be able to reduce it to 12 or 10,000. The companies that loaned you the money want to get something back. They don't want to write it off. So many times they're willing
But
to.
there are credit consequences when you do that kind of an.
There are, but there are also consequences for being deeply in debt. I mean,
Yes.
one of the greatest issues for domestic stress is being in financial debt. I mean, so you not only pay a price in terms of, paying a higher interest rate, a ludicrous interest rate, it also has a tremendous impact on your family structure, including your
Yeah,
kids.
and can be health as well. Yeah, good points. All right, we're winding down. Just, I know we've gone a little bit over the 1 hour shortly, so I want to just let you know we're near our end, but we do have a couple other observations that are not necessarily about the inflation, but when it comes to thinking about where to draw income from, I wanted to talk about this briefly because we get this question often as people are entering retirement or near retirement, and they're planning and saying, well, where will that cash flow come from? And, there's some things that are kind of predictable. If you're working, obviously, you're going to have your earnings first, you're going to spend. If you're not working, if you have pension or Social Security started, you'll take those because you have that as income and you will have tax on that. So you have to take that. If you're subject to required minimum distributions, they would clearly be an important consideration as well. Programming we use oftentimes plans to spend down taxable, which is a joint account, trust account, kind of money first, and then delay all the tax consequences of, deferred accounts like a 401k, IRA type money. And there can be reasons to do that. At the same time, you want to be intentional, as we're talking again, intentionality is an important thought process when we talk about planning, financial planning, because sometimes if you delay all your retirement account expenditures and withdrawals, you can end up pushing your tax bracket into a higher tax bracket because RMDs can become bigger. The required distributions can get larger. So a little bit of planning, a little bit of thought process of can be modeled out. Where should we take from what buckets of resources, when is a great point. For people under 59 and a half, you want to be very intentional, again, not to take from your retirement account unless you're doing it in a very particular way, because you have a penalty tax. And for most people, that's something you're not, you want to avoid, and you don't necessarily want to touch your retirement monies too soon. There may be other things to consider. Just encourage you to consider talking to us about your particular needs. Mike, I mentioned required minimum distributions, and in 2022, there's been some discussion about what's required, what's not. It's the time of year when people who have their own retirement accounts are thinking about distribution requirements. We want to encourage everyone to deal with them now, early. We'd like to get that resolved in November rather than December this year because of the requirements with the broker-dealer. But maybe you can tell us about some of the things that are being discussed as it relates to this issue.
Yeah. Recently, there was a change in the requirements. The original age for distribution, a mandatory distribution, was 70 and a half, and that was recently changed to age 72. So if you're turning age 72 this year in 2022, okay, you have to begin taking out your distributions. Okay, there's charts. Usually the company that you hold your money with will notify you of how much you need to take out before the end of the year. The amount is based on the 12/31/21, okay, value of your retirement account, and that number is divided by a factor which appears in the retirement account charts.
Yeah, this uniform table, which, by the way, also, Mike, you might be mentioning this, but that did get updated in the last couple of years. So people need to make sure they're using the right table.
Yeah. So let's assume quickly that you had $250,000 in your account on 12/31/21, and your divisor was 25 years. Then you would have to take 250 and divide it by 25, and you'd get a $10,000 minimum distribution. And that has to come out before the end of the year. Okay. Now, there's been some changes in regard to what was formerly called a stretch IRA, which is really an inherited IRA. not inherited from spouse to spouse, but from an individual to someone other than their spouse. Okay, this IRA prior to 2019 was allowed to stretch, okay, to the individual's entire lifetime. So if a young person inherited their father's IRA after the father passed and that person was age 50, they could have taken the money out for the remainder of their life, 30, 40 years at least, okay? But that changed with the Secure Act in 2019, okay? And those IRAs were limited to 10 years. But what was peculiar about it was that you didn't have to take annual distributions. You could take the entire amount out over 10 years. Well, that now is being changed. Okay, beginning with the year 2023, okay, you're going to have to start to take annual distributions out of the inherited IRAs. Okay, there will be charts for that as well. So no longer can you hold off till the 10th year to take the money. Now in 2023, you have to start taking it, okay, each year.
So there may be some details as it relates to whether the original IRA was someone who had already started taking their distributions or not. But consult your tax professional if you have any questions. Certainly, we can be of help in talking to you about this issue. But bottom line is there is a requirement to take not only for a beneficiary IRA or an inherited IRA, you're not only over that 10 years, you have to take it all out, but you may have to take some out each year. So thanks, that's good. Good to keep people aware. And this year, the IRS said they weren't going to enforce that requirement for 2022.
Yeah.
Okay. IRAs are complicated, of course, and lots of different circumstances. So if you have questions about your situation, certainly reach out. One last thing, and just as we get to year end, there's some things that people oftentimes think about. Wanted to remind you that, excuse me, it is a good time to be thinking about charitable giving. If you have a required minimum distribution, you may be able to take a qualified charitable distribution and not have to actually take that money and receive it and pay tax on it if you're turning around and donating it to some of it or all of it toward charity. You may want to do it directly. It avoids the income tax, the income at all for the portion that you donate. There is a cap of about $100,000. For most people, that's probably not a problem. But anyway, a qualified charitable distribution, a great tool while you're thinking about year-end required distributions. It's still a time where people are thinking about Roth conversions. While markets are down relatively, maybe not at the lows, but we're still down, it can be a good time to entertain a Roth conversion if that's something you're considering. There can be value in doing that because you can, again, if you're in a position where your IRA is going to push you into a higher tax bracket, there may be some merit to taking some of that tax now, perhaps at a lower rate, so that you don't get pushed into a higher rate later on. And then finally, this time of year, people oftentimes think about tax loss harvesting. We have been doing that all year long for our taxable accounts, for people who are in a discretionary managed program with us. One of the things people sometimes they don't get, why do we want to do this? Essentially, we're taking a consolation prize when markets are down and we can swap out something at a loss for something very similar. It's essentially staying invested, but we're capturing a tax benefit that we can push that tax off later. And there's some virtue in doing that for when we have capital gains along the way. I want to invite anyone who has a question to use the Q&A button. There's also a chat feature. You are welcome to raise your hand if you'd like to ask a question verbally. While we wait for any questions that may arise, Kathy, I'll let you tell a little bit about what we have going on in the office here.
Great, thanks, Chris. We have decided to be a designated drop-off location for Toys for Tots this year. I'm sure you've all heard about the program. It's a U.S. Marine Corps initiated program, and each winter holiday season, they have their annual gift drive. We encourage you, or welcome you, I should say, to bring in an unwrapped toy if you're so inclined to our Hyannis office at 1060 Falmouth Road. If you're coming in for a meeting or you just want to drop by and say hi, anytime between 10 and 4, and between now and December 3rd, we'll be taking toys. And then, of course, taking those and dropping them off at Toys for Tots after we've collected. Be sure to let us know when you bring a toy in, because we're going to enter you in a drawing for a $100 gift card to Trader Joe's. So it's a good way to help local kids who can't, whose families can't necessarily afford to give them a Merry Christmas or Merry Holiday. And we're glad to participate in that. As you can see, last year, there were over 44,000 toys distributed and over 19,000 children were supported by it. And it all stays local. Those toys stay on Cape Cod.
Nice. So I hope you'll consider joining us in that effort, and if you're able to. All right. Well, with that, I guess we will wind down for our program today. Thank you all for participating and sharing your time and in some cases your questions and comments. For our reminder, we do have a upcoming webinar in January where we'll talk about what's happening in the markets and how it's working its way into our outlook and strategy designs. I want to remind you that we do have some disclosure here, but let me just take this last moment to say thank you as we approach the season of Thanksgiving. We are very appreciative for the trust that you all place in us as your financial planners and portfolio managers. We take that very seriously, and we appreciate it greatly. So thank you for making the time. And if there's anything we can do to be a resource to you, please reach out to us. Give us a call at either toll-free 866-771-8901 or locally 508-771-8900. I think that's it for the program. Everybody, thanks for your work, guys. Thank you, Kathy. Great job. Thanks, everybody. Bye-bye.